Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, I'm back here on the Investor Coaching Show. I'm Paul Winkler talking money and investing. Okay, so one of the things that came up on the News Channel 5, OpenLine, the question was this. Paul, when is this bubble going to burst in the stock market? It has been funded by tons of money getting printed, the money supply increasing, and all of the government spending and all of that stuff. And that's basically what's been funding everything. With this thing is just going to burst. What do you think about it? And my point about that is this. Number one, and I didn't make this point, I probably should have made this point first, is that the idea of when is something going to happen? What is going to be the timing of it? Let's put it that way. Let's just say it that way. What's the timing? It's market timing. Now, what do we know about market timing? It doesn't work very well. We know that there are studies of pensions, and one major study of almost 100 pensions found that not a single one of them increased returns as a result of their efforts to time the market. So it's just not a good idea. It doesn't make a whole lot of sense. So one of the things that we're going to be looking at right there is how do we figure out when, and then the next question you have to ask is, well, which market? Is it large U.S. stocks? Is it small companies? Is it value companies? Is it large international value, small international value? Is it going to be, what market segment are we talking about is in a quote unquote bubble? Now, one of the things that I comment on is if we look at stocks in general, if we just look at market segments and say, okay, are they selling for a price that's just ridiculous compared to the earnings that are coming in? I said, because you got to recognize, sir, that you're buying the rights to a company's earnings. Now, historically, if you've listened to this show for any period of time, you've heard me probably say this, that large U.S. stocks, as would be measured by the S&P 500, have sold for about 16 times earnings. So you pay about $16 for every $1 of earnings that you get. Now, it would mean to us that it was ridiculous if all of a sudden those companies were selling for 50, 60 times earnings. Now, the fact that they're selling right now for pretty close to that, it's a little bit above. And why is it a little bit above? Well, it's because it's a static number. Now, what is a static number? The earnings number. You're looking at what the next year's earnings, if you're looking at forward earnings or what the earnings are going to be over the next calendar year. Let's just put it in terms of a company that has $1 billion of earnings that they expect they're going to come in over the next year. If you look at this company, you study the company and you study the balance sheet, study their marketing and study everything, and you say, oh, well, it looks like it got about $1 billion of earnings that are coming in. What if I said, hey, I want to buy the whole company? Well, what would I pay historically? About $16 billion for the whole company, right? Now, if we're looking at what's happening right now, it's a little bit above that. Maybe those companies are selling on average for $20 billion. A company that has $1 billion of earnings selling for $20 billion. Well, why? Well, the reason is because it is looked at as an opportunity for earnings to go up even more in the future. Why? Because of the fact that you have efficiencies in terms of productivity that are starting to enter the marketplace. There are things that could cause those earnings to grow. So let's say that your earnings double. Okay, so let's say that you're selling for 20 times earnings. And just to give you a ridiculous example, just so you get the idea, all of a sudden, let's say that the earnings are going to be $2 billion. Well, now, if you have companies selling for $20 billion, and the earnings are 2, what's the ratio now? It's 20 to 2, which is 10 to 1, right? Okay, so in effect, we look at 10 to 1 as going, well, that's way less than the 16 to 1 that it normally is. So you can't look at that and say, oh my goodness, this is just outlandishly high, because what happens in the future, or what could happen, is higher earnings. Now, if we look at it and say, well, is it higher than normal? Yeah, it is. So, that's why we diversify. We don't just put it all there. But there are market segments right now that are selling for 9 times earnings. You have companies selling for 12 times earnings, 15 times earnings. You have companies that are selling for fairly near the norm. And therefore, what we would look at is saying, well, wait a minute. I don't see anything outlandish here. I don't see anything crazy going on. Therefore, that whole idea that earnings or that these prices of stocks are outlandish because, compared to earnings, is just unfounded. Now, the other point that I made, which I haven't made on this show for a while, but I think it bears talking about and repeating, is that we have this thing about, because it may have been, may have been Ben Hall, the reporter, that actually, he and I go on there together. He may have brought this up. It may have been him. I can't remember. Anyway, it was the point that, well, you've got, this money flowing in, and the money could be flowing in from various sources because there's going to be a new demand for the stock market. I know what it was. We were talking about Social Security. That's what it was. We were talking about this program that had been put out there, and I talked about that on this show last week. And if you didn't hear me talk about that, it's fascinating. They're playing around with this idea, and it was an op-ed on this, that we're going to borrow $300 billion with a B. The Social Security system, we're going to borrow. This isn't like in stone or anything like that, but they're talking about borrowing $300 billion a year for 5 years, or $1.5 trillion. And the idea is we're going to borrow that money and we're going to invest it in the stock market. And they're going to do something like the thrift savings plan, which I talked about how, thrift savings plan, it just isn't very well diversified. You'll have large U.S. stocks, you got small U.S. stocks, and you have international large. That's it. And you can do some other things, but it's really expensive to do those other things. So you have extra charges on your thrift savings plan, so hardly anybody does it. But the idea being they're investing in all growth stocks, which would have higher costs and lower expected returns going on in the future. But here it's what they're talking about doing with this money, just investing that. And the question you ask yourself is, well, why? Why are we looking at doing this? Oh, it's to save the Social Security Trust Fund. Was how it's being couched. And I said, that's ridiculous. That's ridiculous. Because they're talking about investing this money for 65 to 75 years. That's what they're talking about doing. Let's invest $1.5 trillion for 65 to 75 years, and it's going to be in a lockbox. We won't touch it. Well, how does that fix a trust fund problem that's 8 to 9 years away? And the answer is it doesn't. This doesn't make any sense. But that's how it was being talked about. And I have the audio from that, on last week's show. Well, the question that Ben asks is, well, what if they did that? Would it create all kinds of demand, and would it drive the stock market up? And I says, not necessarily. He says, well, why? I says, because if you have some people buying, you're going to have somebody on the other side selling. And he's like, oh, good point. Yeah, so if people buy, and it's the exact opposite of a point that they tried to make, probably, 10, 15 years ago? And I talked about this on the show here. And it was the idea that baby boomers are going to start retiring like crazy. And the thing that's going to happen with the baby boomers retiring is that it was going to crash the stock market, because they're pulling money out of the stock market, and because there's demand is going to dry up for stocks because you have all this supply out there. And it seemed to make sense to a lot of people, except for me. Because I sat there and I said, this is crazy sauce. Stop this. You guys are market timing. You're trying to tell me what the market's going to do based on the supply and demand and based on baby boomers retiring. I said back then, and I still stand by it, is that baby boomers are going to still hang on to stocks even throughout their retirement, number one. And number two, younger people coming up behind them will make a market buying those stocks. So you'll have somebody on the other side of trade, because when the baby boomers were to sell these stocks, they're selling the rights to the earnings of those companies going forward. And there will be a market for somebody that wants to get those earnings. So to make the point that you think the stock market's going to crash because some person is going to sell, but you forget on the other side there's going to be somebody that buys, is just not, it's ignorant, okay? I mean, that's just it. There's no other word for it. So that point is the opposite with this idea we're going to create all this demand for stocks with this Social Security thing. And I just don't, I don't see this thing going I don't know. I would hope it doesn't go through. And a point that I made about that on TV, and I made about that last week on the show, is I don't like the government anywhere near buying stocks in public companies, simply because when they have voting rights in these companies, what political pressure will they bring to bear on these companies if they're not doing what they want them to do? And I use the example of ESG, environmental, social, and governance. I mean, we don't have to go back very far where people were just up in arms over the pressure that politicians were putting on companies that weren't playing by their environmental rules or their social rules. What they wanted to do social engineering around. So the reality of it, it's just not palatable to me for them to get involved in that. They better have some really good safeguards if they do anything like that. But, I'm just here to bring public awareness around this, because I think you need to know this stuff. But anyway, I thought it was a really interesting question. Now, another interesting question, one of the things that we talk about a lot on the show, I talk about what is an investment and what isn't an investment. There are a couple things that I have basically adamantly said are not an investment. And I want to talk about one of those things, but I'm going to do it by using something else that is coming up in the news as being, whoa, wait a minute, this thing is not as valuable as it used to be. And it was often thought of as an investment. And all of a sudden, the world is changing around it. I'll get into that right after this. Thanks for tuning in to the Investor Coaching Podcast. Now, you may be one of these people that's been listening and realizing, wow, investing, there's a lot more to it than meets the eye, and financial planning, tax laws constantly changing, and recognizing that maybe you might need some help in this area, but you don't want just anybody to help you out. So we have 10 offices in the Middle Tennessee area, and everything that we do is fee only. We align our interests with your interests. So you can get an initial 15-minute phone call with any one of our offices just by going to paulwinkler.com/call. That's it. Every one of the offices is run by somebody with 20 plus years experience. They're all degreed planners. They all have academic backgrounds in investing, and you can get the help that you need. So if you want to set up a complimentary phone consultation, just go to paulwinkler.com/call. And we look forward to seeing you soon. All right. I am back here on the Investor Coaching Show. I'm Paul Winkler, talking money and investing. And, okay, so one of the things that I have a lot of conversations about are what are investments and what are not investments. Now, the idea behind an investment, definition, and Gene Fama, the guy I studied under, would chase around all over the place wherever he was teaching. He was this economics professor that was studying what was called multi-factor and market efficiency, and he was just brilliant. And I was enamored by the stuff this guy was teaching because it made so much sense. And, we had been regular brokers working for investment companies, securities offered through blah, 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 that type of thing, and insurance agents, and all of us came from that. And I was just like, I can't do this anymore. And that's how this show started. Well, what happened was that he got into talking about investments of all different types. And one of the things that was in a lot of his teaching was the definition of an investment. And the idea being that when I invest in something, there should be a cost to use my money. We call it cost of capital. And the idea being that I have to have some kind of payment for the use of my money. Now, if we have a CD, it's going to be interest. If we have a savings account, it's going to be interest. If we have a treasury bill, it's going to be if you have short-term treasury bills, they're sold at discounts. So what happens is an appreciation. You pay a discount. When you buy for something for a discount, let's say that you pay $900 for it, and then when it matures, it'll be worth $1,000. That's what I mean by discount. It's the idea that you pay less for it than what it will mature for or be worth at some point in the future. Well, it's an imputed interest is what we call that. Then you can have, let's say, real estate. Now with real estate, I get paid rent, because somebody buys or gets access to the property and uses it for their own purpose, whatever that happens to be, and they pay rent to actually use that. Now with corporations, you actually get the company's earnings because you're an owner of the company. So the earnings come through to you. There is a cost to use your capital. That's the idea behind it. Now, if we're looking at, let's say, a commodity like wood, you have lumber futures and those types of things. Or if you have a commodity like copper, or if you have a commodity like silver, or you have a commodity like gold. There's no cost to use your money. Now, there's all kinds of people out there calling it an investment. And that's because they stand to gain if you buy it, because they buy it, they mark it up, and they sell it to you. They would just love for you to pay more than they did, and that's how they make money on this thing. So they create all kinds of demand, and it's usually by scaring you in these particular things. And we can scare you into thinking, oh my goodness, the whole world is ending. And if they really believed their shtick, that the world was ending and the dollar was going to crash, then what they would do is they would actually just keep their doggone silver. They would keep their gold. They would keep these things because it makes no sense to let it go if it's supposed to appreciate so much. But of course, they're more than willing to sell it to you. Well, one of the things that I actually did is I was talking about the Twilight Zone one day on TV, and they had this whole thing about gold. And the long and short of it was there was this gold heist. They had robbed a train of the gold, and this brilliant guy had figured out a way to put all of the guys that had robbed the train to sleep for 100 years. And they figured after 100 years, then what was going to happen is people would have forgotten about the train heist. They would have forgotten about the robbery of the train of its gold. And they could just be free to go and be rich people and live the wonderful life 100 years later. Well, the story just went, I'm going to ruin it for you, is that they basically, one of the guys died in the cave where they had been put to sleep. And the other three guys came out, and then what ended up happening is, or the other two guys anyway. So they're going along through the desert, and the one guy forgot his water, and the other guy didn't forget his water. And for every drink of water, he had to give up a bar of gold for every drink of water that he wanted. And he gets through the desert and finds out, oh my goodness, I'm out of gold bars. So he kills the other guy. Come to find out that the gold wasn't worth anything because they had figured out ways to manufacture the gold. Well, the Wall Street Journal had an article, are diamonds even a luxury anymore? De Beers reckons with price plunge. And they said that, this guy wants to save a generation of lovers and newlyweds from what he calls a huge con when it comes to buying diamonds. In the process, he hopes to rescue his iconic brand, and perhaps the diamond industry has existed for the last century. From an ominous decline, stones were not only prized for their beauty, but the miracle formed over many, many, many years, and they're extracted from the earth and blah, blah, blah. And he says now they can make them in labs. And it just reminded me of that whole thing with the Twilight Zone. We can make it in a lab, so it's not worth anything anymore. Or it's for a fraction of the price. And it says Walmart sold their first lab-grown diamonds in 2022, and now it makes up half of their jewelry assortment. Synthetic diamonds currently account for more than 1/5 of the global diamond jewelry sales. Wow, up from less than 1% in 2016. I mean, it just reminded me of that. Can you just imagine? And that's the problem with commodities. They don't produce anything. If you have a greater supply, it can really shoot you in the foot.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.